For the latest in strategic affairs, subscribe to our YouTube channel. Click the bell icon for updates.
Did you know that US imports from China this February was $30.6 billion? It's down from $42.3 billion last February. Did you know the MSCI China index was down 5% in April? It is the biggest fall witnessed in the worldwide. Hello and welcome to another edition of Capital Calculus. I am your host Anil Padmanabhan. Today we take up China, its economy, and the growing global scrutiny of China for discussion. China's pursuit of a zero-COVID policy has made a bad situation worse. This is most visible in the trade data issued by the country. Yet, this has not stopped international institutions like the International Monetary Fund in issuing rosy forecasts about the Chinese economy's recovery. All this while private forecasters are arguing differently. What is the truth? To understand this and more, we spoke to Shehzad Qazi. He is the Chief Operating Officer of the China Beige Book International. China Beige Book is the largest private database on the Chinese economy. I began by drawing Shehzad's attention to a recent tweet by him, in which he pointed out the contradiction between declining capacity utilization and growing manufacturing output in China.
I think as most China watchers realize, piecing together different parts of the puzzle when it comes to official data is always a bit of an exercise, and often, so it can be challenging. Sometimes it can be incredibly challenging to put together a story. This time around, when the GDP print came out of 4.5%, quite frankly, it was very, very surprising. It seemed a lot, the jump seemed a lot bigger compared to last year than one would have imagined, especially, taking into account that the economy wasn't doing much. If you looked at January and February, given, of course, the first 2 months of the Spring Festival and the slowdown in economic activity that just takes place in general, then considering that we're now only coming out of the zero COVID policies and so on and so forth. But the thing that really caught our eye was the fact that while you were getting a year-over-year growth print in the manufacturing and industrial component of about something like a 2.8% or so, you were simultaneously getting a pretty sharp drop year-over-year in capacity utilization, which of course raises a lot of eyebrows because it makes you wonder, how is it that when less capacity is being used this quarter compared to this, to last year, well, then how is it that production and output and growth is going up? There could be obviously explanations for that, right? Technological innovations have come to the market, or apparently there's been a ton of hiring, and so you have a lot more workers still producing more. But, you don't really see that happening. It's not like the unemployment rate saw a massive fall off. The unemployment rate is actually still, even for all its faults and shortcomings, disturbingly high by Chinese standards. And of course, we know that it's infeasible to conclude that somehow a massive amount of some technological revolution magically took place in the last few months, which may account for this. So I think it just speaks to the continual problem of dealing with official numbers in order to really, truly understand what's happening on the ground in the Chinese economy.
Shehzad has a point. Trade data too suggests that the Chinese juggernaut is slowing.
One of the problems that we're seeing is, of course, that export data, as it relates to the United States, as it relates to the European Union, continues to contract by the double digits. It's not a minor contraction, which again, suggests to us that, foreign demand is certainly slowing down. And whereas you may get 1 to 2 month blips on the radar where things do better, they turn up. I think for the rest of this year, the long-term trend, or I should say that the trend for this year, is certainly is geared toward the slowdown. Again, raises those questions. How is it that manufacturing in general is doing that well? It makes you focus more on then what's going on the domestic side of the economy. where I think even Chinese policymakers have come out over the last day or so and said domestic demand isn't where they would like it to be.
Another counterintuitive thing about China is that its economy has grown in size despite the COVID-19 pandemic and the pursuit of a zero-COVID policy. It has grown from about $14 trillion pre-COVID to about $17 to $18 trillion today. All this while most major global economies, including India, witnessed a contraction.
One of the things that we've seen happen during COVID is, and not just because of COVID, because the initial impact of COVID, of course, in 2020 was much more disastrous than was even acknowledged in the official GDP numbers, because the economy was essentially shut down for the first 3 months, and the recovery from that slowdown was actually also a lot slower than you saw in official numbers. What we got that year was that the National Bureau of Statistics in China had gone back and looked at 2019 numbers and just started revising down 2019 figures to just make the nominal, to make the growth figures for 2020 look a lot higher, because the nominal figures weren't going to do that. But putting that aside, I think one of the things that has happened simultaneously to the COVID and then zero COVID induced slowdown in the Chinese economy is the realization now, I think, not just within and among Chinese policymakers, but I think within Wall Street, finally, and other China watchers, that the economic model that we had all come to rely on for getting these double-digit growth figures from China, or even things as high as 8%, even 6.8%, 6%, those years are now behind us, that the economy can no longer produce that impressive level of expansion. The road has run out on all of that. And that leads, of course, to broader conversations about changing of the economic model and so forth. But I think these numbers just tell us that even if COVID hadn't struck, I think the economy was starting to reach, that model was starting to reach the end of its road. And it just happened to be that COVID may have accelerated some of that. But the structural changes were happening, and that they're happening rather fast.
It is obvious there's more than what meets the eye when it comes to China measuring its own GDP. As Shehzad put it himself, in China, the GDP is a political number and not an economic number.
Most countries, and especially some of the largest economies, the advanced economies, the GDP is a number that you arrive at. In China, the GDP is a number that you set at the beginning of the year, and then you do whatever is necessary in order to hit it. That old communist era command and control traditions have persisted when it comes to the Chinese accounting of growth. So what does that mean? Well, what it has resulted in over the last couple of decades, it's just been very, very obvious to everybody, and longer, but certainly over the last couple of decades, that no matter what needs to be done will be done in China to hit the GDP figure, which means that the growth you're getting is not always productive. The growth figures that you are getting will be digging a hole and refilling it, as Keynes would put it, moving a crane from one place to another. It can result in all sorts of activities, as we saw recently during zero COVID, when local governments started selling land to entities that were actually owned by the local government themselves. They were not corporations. The government was essentially selling land to itself in order to generate growth and order to generate revenues for itself in that case. But you start seeing all these things happen because also, of course, the political fortunes and the political futures of Chinese, governors and different officials are ultimately linked to their ability to hit their allocated GDP targets. And of course, you end up with rather funny things happening then. You sometimes get provinces which will report a GDP growth rate that has been so high that the center has said that if you were to add up all the provincial GDPs, it would actually be higher than what the center was claiming. And the government itself has had to say, this is not right, this is manipulated, you have to go back and revise it down. So these are some of the things that have happened, which have not only made the GDP somewhat less useful, especially for markets, I would say, as a way to gauge how you invest in the Chinese economy, but just continue to clarify that it has political salience and should be looked at as that rather than a helpful figure for how the economy is actually performing.
What do we make of the projections by the IMF about the Chinese economy?
The IMF projections of about 5.2% are essentially the median, the midpoint of what the government has said, right? The government has a target, I believe, of just about 5.5%, but they'll be willing to live with 5%. Now we'll see if this surprises at the end of the year, as a lot of investment banks think they will. Investment banks have gotten very, very bullish and now claiming, a 6.5%, 6%. I've seen one projection at almost around 7%, which I think is just very, very crazy. But in any event, the IMF runs off of, again, the IMF or the World Bank, but we're talking about the IMF right now. But most of these international multilateral financial institutions, again, suffer from a similar problem where they don't have access to their own numbers. So they have teams of economists, which are no doubt very, very impressive, smart people, but they ultimately rely on taking official figures, putting their own twisted turns on it and adjusting numbers here and up and down, and then, spitting out a projection, which is why you will see that the IMF projections are almost pretty much always in line with the government saying anywhere.
Indeed, if China is slowing down, what does it tell us about the world economy?
It tells us that the global economy is about to go through, a few years of, first of all, we've already, for the last 3 years, we've already been, in certain aspects. We've seen growth slowdowns take place because of the COVID-induced shocks. We're dealing with this global inflation problem. We're in an environment of very high interest rates globally, which aren't going anywhere. I mean, the interest rate environment has just completely changed from what the world has been used to for quite a while. And I think that's going to be coupled with a slower pace of expansion than the world has been used to for quite a while. Pre-COVID, obviously, you had a Chinese economy which was still planning to deleverage, planning to cut back on its excessive industrial output when in regards to steel and aluminum and so forth. But it wasn't there yet. It is now much more on that road. Certainly we don't know what the stopping point will look like. But I think what it tells us is that the global economy has several more years, at least, given where China's headed, probably of much slower growth than was anticipated.
One big concern is that a slowdown of this magnitude and pace is disruptive for the financial health of companies. This in turn poses severe risks to the financial sector in China.
One of the things that we always caution folks against is trying to predict that China is going to have this big, earth-shattering debt crash that will completely destroy the economy and have massive global repercussions. The hard landing thesis, or that China is about to face a Lehman moment, etc. The reason we caution against that is that, you need to understand that the Chinese system, the financial system, is not a private financial system. The banking system is overwhelmingly state-run and state-owned, which gives China a unique ability to erase its debt crises the way it doesn't in Western economies than the United States. A very different system. So whereas, again, I think the Evergrande crisis and the property market crisis may be about as closest to a hard landing as one would have gotten in China. So the fact remains that you will still continue to see, I think, mini crises, and as far as credit crises are concerned, erupt in China. You still have lots of developers who are still struggling to rebound, still struggling to do well, or repay their debts. They're still negotiating their repayment structures and so forth. I think the property market is in for a long-term restructuring, which means that you will see the cyclical slowdowns along the way. You may even get crashes here and there. So I think that continues to remain, I think a big headwind, or rather a big risk to Chinese growth.
Shehzad is arguing that since the banks are owned by the government, there's some cushion against a meltdown. But surely there are finite limits to the ability of the government to continuously bankroll bad debts.
Well, I guess we'll know when we get there, is the honest answer. So far, I think what we've seen is that the Beijing has been remarkable in its ability to undertake fancy financial accounting. One, no less, of course, that was helped in, early in the 90s and created, I would say, by the likes of Goldman Sachs and JP Morgan, who helped, whitewash the initial problems that happen in Guangdong and create these bad asset management companies, which is a model that, of course, the Chinese policy planners have just essentially relied on since then. So far, we've seen this remarkable ability to take bad debt, have it be purchased by one authority, have that debt purchased by the central bank, essentially, and clean out the money that way. Does it have a limit? It's hard to say. So far, it hasn't.
What about the opportunity cost of the fiscal misadventures of the Chinese government?
The real problem, I think, is that even if you have the accounting ability and the financial ability to keep doing so, because the debt is ultimately denominated in your own currency, the problem you run into is not so much can I keep doing this, but what is the downside risk of doing all this? And the downside risk is that you're taking a pot of money which could otherwise be invested in much more productive uses for much more prosperous things to actually drive the economy into new areas, for technological advancement, for R&D, et cetera, to give to companies that are actually be innovative. And you're taking that money and you're just constantly throwing it after companies that are failing because all they have done is taken out risky ventures. They have, they're over leveraged, they're not innovative, they're not growth, they're not productive the way they're supposed to be. And you're just constantly backing them up. You're constantly throwing good money behind bad, as the saying goes. That's the real problem, right? So the problem is you're ultimately kind of, you're really slowing down the prospects of your own economy's improvement, expansion, innovation, and growth by undertaking these projects. That's a real challenge for China.
It is then clear that the world and global investors need to do a reality check on the Chinese economy. All the more because foreign investors have a lot of money locked into China, and needless to say, China continues to be a pillar of the world economy. The fault lines are worsening. For one, the years of runaway growth are over. Second, as Shehzad pointed out, the constant cover-ups of debt meltdowns will at some stage start exacting an economic price. And all this in the midst of a geopolitical reset when the Western nations are trying to decouple from China. In short, we are in for lots of more turbulence. As they say, watch this space. Thank you for watching. Don't forget to subscribe to Strat News Global on YouTube. Hit the bell icon so that you don't miss any updates. And please do share your thoughts, ideas and suggestions with us. I'm available on Twitter at Capital Calculus. I'll be back next week with another episode, and hopefully this time I would have won the battle with my throat virus.